So recently, I had a number of people ask me to create more videos on option strategies for small accounts. So in this video, I'm going to share with you an SPX option strategy that you can trade if you have a small account that is not only safe, but it also has a high win rate. And more importantly, it is net profitable over the long term if you trade it correctly. So first of all, let's talk about the advantages of trading SPX. So there are a few main advantages. So the very first main advantage is that it's cash settled. That means to say there is no assignment of shares. And this is something that I find a lot of beginners tend to do, and I get a lot of emails, is that they actually get assigned on their option trades. So maybe they have a short put on, or maybe they have some put credit spreads on, and now their trade is in the money, and that's where they get into assignment of shares, and then they could get even into a margin call when they don't have enough cash to actually fulfill the obligation to buy those shares. But with the SPX, you don't have this problem anymore because there's no assignment of shares whatsoever. Everything is cash settled. So as you can see over here at the bottom, this is from the CBOE website. So you can go over there to take a look, and you can see they say down here, trading account is being credited or debited in cash. So that's why it's called cash settled. Now, the next main advantage is that this is the European style options, which means to say it can only be assigned or exercised at expiration. That means to say no early assignment. So this is where you can actually hold the trade all the way to expiration, which is what a lot of beginners like to do. They like to hold all the way to expiration because they want to realize the full profit of the trade. Well, you can actually do that on SPX because there is no early assignment. And finally, this is only if you are a US resident, and that is you have potential favorable tax treatment. As you can see over here, this is mentioned as well in the table. Capital gains may benefit from the 60%, 40% tax treatment. So if you're in the US, then definitely go ahead to their website and they will let you know a little bit more about this. Now, here's one very distinct difference is that if you have a small account, then I would suggest that you start off trading the mini SPX first. So the ticker symbol for the mini SPX is XSP. You don't want to start off trading the SPX first, but start off with the mini SPX. And you might be wondering, why trade the mini SPX first? Well, the main reason is because of the risk element here. So the mini SPX is 1/10 the size of the SPX. So that means that it's less riskier and you can actually position size better. So over here, you can see that I have two option chain. On the left-hand side is from SPX and the right-hand side is mini SPX. So I want to compare both of them to explain to you why it's less riskier if you have a small account trading on the mini SPX. So let's just say, for example, you want to risk maximum of $350 per trade. So as you can see over here at the bottom, you can see that the max loss is pretty much the same. So what I've done is I've constructed a very simple strategy called the put credit spread on both SPX and mini SPX to show you the difference. So first of all, they both have the same risk. So you might be saying, okay, Davis, since they are both the same risk, why don't I just put it on the SPX? Well, here's the main difference. If you take a look at where the long put strike is for the SPX, you can see it's 5475. Whereas on the mini SPX, for the same risk that you put on for the trade, your long put is being stretched further out to 543. So remember, mini SPX is 1/10 the size of SPX. That means to say, if you were to construct the same exact spread on SPX, your long put would actually be at 5430, which means to say your risk is actually going to be much bigger. So what is the difference between these two? Well, the difference is where your max loss is. And this is very important because you see over here, for the SPX, let's just say the market actually goes down to 5480 and it goes to 548 on mini SPX. So basically it's the same movement because mini SPX again just 1/10 of SPX. So when the market comes down to 5480, all it takes for the SPX to have a max loss on the trade is just all the way down here past 5475 at expiration. So at expiration, let's just say for example it lands at 5470. On SPX, you're going to lose everything that you risk here, $350. But what about the mini SPX? So mini SPX is going to be at 547 because remember again, it's just 1/10 the size. So if the market goes to 5470 on SPX, it just means that on the mini SPX, it actually went to 547. So if it expired here, on your SPX, you lose everything that you risked, 350. But on mini SPX, you actually don't lose everything because it's not past this long put down here. Only when it goes all the way past the long put, then you're going to have the max loss. So if the market just lands at 547 expiration, then you're going to lose much lesser than the max loss. So this is where a lot of beginners don't realize or don't understand as well. So on mini SPX, if you're going to put on the trade with the same risk as SPX, it's going to be harder for the market to take you out for a max loss. Whereas for SPX, it just takes a very small move, right? 5475 equals to 547.5 on the mini SPX. So it's a very small move for you to be taking the max loss. And if you were to take a look at the max profit, as you can see on both sides here, you can see that the max profit in SPX is, yes, it's more, but it's only slightly more. As you can see over here, it's slightly more by $9 only. So for $9 more, you're actually taking on a much bigger risk because your long put is so much closer to where the current market is compared to the mini SPX. So that is why if you have a small account, start off with mini SPX first, and then later on when your account grows, and I would say maybe 50,000 and more, then you can start to go to the SPX. So if I was to plot this on the chart, you can see visually how close the long put is to where the current market price is. So you can see current market price is somewhere here. The market just have to drop a little bit past the short put for you to hit the max loss. Whereas on the mini SPX, it takes a much bigger move for you to eventually get a max loss on this. Okay, so now that I've got this out of the way, some people might pull out the XSP option chain and then they will go, but Davis, there's no liquidity because the open interest is so low, right? You can take a look at the option chain on the right hand side. You can see that some strike prices have zero open interest, and a number of them have very few open interest. As you can see, 1, 1, 2, 2. So this is where many beginners think that because the open interest is low, it's going to be very difficult to get filled or very difficult to exit the trade if you enter into the trade. And that cannot be further from the truth. So first of all, in terms of the bid and ask spread, yes, it is slightly wider than the SPX, but that doesn't mean you cannot get filled. So here's the very important point that you need to understand. Many people have the misconception that if there's little to zero open interest, you cannot enter or exit the trade when you want to. But that is definitely not true because the open interest just indicates the number of outstanding options contracts that have been traded but haven't been settled or closed. But that doesn't mean you cannot enter and exit, because a number of people, the misconception really lies is that, oh, if only 1 or 2 people trade there, that means it's very hard for me to get out because I don't have that many people to trade against when I want to get out. But that's not true, because why? It's not you and I, it's not traders that actually take the opposite side of the trade that we want to put in, but rather it's the market makers. Market makers are the one that's taking our trades, and they are obligated to take our trades. Now, provided it's at a price that they are willing to buy and sell at. So this is very important concept to understand when you're trading options, is that these prices that you see down here, the bid and ask spread, all these are being quoted by the market makers. That's why they're called market makers. They make the market, which also means these are the prices which they are willing to transact at. Which means to say, let's say if you want to sell an option, let's just say, for example, 541. I want to sell the put option at 541, and you can see the open interest is 0. Does that mean I cannot get filled? No. It means that if you were to sell it at 8.43, that is the price you want, let's just say, you're going to get filled. You're guaranteed to get filled because this is the price that the market makers have already said they're willing to buy from you. Now, the ask side is the price where they're willing to sell it to you at. So you can see this is their spread. So if you're willing to buy from them at 9.03 or you're willing to sell to them at 8.43, you will get filled. And it's actually already shown in the actual order ticket itself. So as you can see over here, if I was to click the 541 at the bid and I was to sell this put option down here, you notice that at the bottom, there's this slider over here. You can see that on the left-hand side, it says net. This means natural. It means to say this is the price that you will be guaranteed to get filled at that point of time if you lower your price to what the market makers is willing to take your price at. And on the other side of the spectrum, you have what is called OPP. And mostly, I think this is what is called opposite, just the opposite side of the price. And to me, this is what I call the dream price, because it is the price which you want to sell at, right? Who wants to sell at a much lower price? We always want to sell an option at a higher premium. So you can see down here, 9.31. this is the dream price because you will never be filled over here. So this is where the mid comes in. So usually when you place the order, you start off with the mid, but that doesn't mean you will get filled. So this is where a lot of people make the mistake thinking, oh, I've already placed this order at the mid at 9.10, but I don't get filled. I tried to lower it down by a few cents. Maybe I lower it down to $9, but I still don't get filled. There's no liquidity in this underlying. Well, that's not true. It's not that there's no liquidity. It's just that you haven't lowered your price enough for the market makers to be willing to take on your trade. They want to make sure that it's at the price that they're able to actually hedge their trades at. So that's what the market makers actually do. They don't actually trade against your positions. Instead, what the market makers do is that they take your trade and then they will hedge it in the open market. So in order for them to actually do this, to hedge, they want to make sure that the price is according to their own, algorithm. So everything is all done with an algorithm. It's not some person manually looking at the price and say, I like the price, maybe I want to take it. No, all this is all happening very fast in split seconds. So they have their algorithms to know what is the price that they're willing to take your order at. So if you lowered the price and you still haven't gotten filled, that means it's just not at a price where the market makers is willing to take on your trade. So if you look at this slider down here, it's like as though you want to sell your car. Let's just say you have driven your car for quite some time and you want to upgrade to the new car. So you want to sell your existing car. So you want to sell your existing car. For you, you always want the highest price possible. So maybe you are going to say, okay, I want to sell this at $910. Let's just say I want to sell the car at $910, and then you want to sell it to a car dealer. So the dealer will be saying to you, no, the best price I want to buy is at $873. If you sell it to me at $873, I will buy the car from you. But you're going to say, no, I don't want that. So this is where the whole negotiation takes place. You're going to say, oh, I want 900. Then the dealer is going to say, no, I want maybe 880. Then you might say you want 895, so on and so forth. So this is exactly what's happening in the option market as well. As you can see over here, this slider from the mid to the natural, you're going to get filled somewhere in between. So this is where you want to adjust it low enough until finally as close as to the 8.73, but definitely you do not want to go to 8.73 because that's the worst price you can get filled at. So this is where negotiation takes place, and even though if you see open interest is low, you still can get filled because remember again, it's not you and I that's taking the opposite side of the trades, it's the market makers. Okay, hopefully I've settled this issue once and for all because I get quite a lot of questions on this. So now let's move on to the strategy. So what is the strategy? We're going to trade on SPX, or rather the mini SPX, and that is the Condor. So the Condor comes in two types, right? There are two flavors for the Condor. First, you have the put Condor. So this is where if you're a little bit more bearish, you think the market is going to go down, then you put on the put Condor. So the put Condor consists of two simple strategies. On one end, you have the put credit spread at the bottom, and then you have the put debit spread. So over here, you might be saying, this looks a little bit familiar. Doesn't this look like the Iron Condor? And the answer is yes, but there's a slight difference. And the difference is that you notice this debit spread down here, this put debit spread, the width is actually much smaller than this put credit spread down here, because the whole idea here is to use the put credit spread to finance the purchase of the put debit spread. And when you do it this way, there's no risk to the upside. So let me just show you an example of what I mean over here. So let's just say you sold the put credit spread for $1.37. So down here, you receive $1.37. This is the premium that you have. So in order to purchase this put debit spread, you want to spend within this amount down here. That means you don't want to go past $1.37. So let's just say you purchase this for about $1.07. So what is the spillover? The spillover is that you have a net credit of 37 cents. So what does this do? So what this does is that, let's just say you are wrong on the market direction. The market doesn't go down, instead it goes all the way up. Then guess what? You actually do not lose any money on this trade. You still get a profit. So over here, you can see this is how the actual profit zone of the Condor looks like, the put Condor. So if the market was to go inside down here, this is where we have our maximum profit. We make the most down here. So how much do we make? I'm going to show it to you later on when we go over the option chain. I'm going to construct it for you so you can see for yourself. But what you need to know is that because you have a put debit spread down here, we actually want the market to go down. And on the other hand, down here, we have a put credit spread, which means we want the market to actually go up. So you can see we have a combination of two different strategies down here to form this strategy over here. So ideally, what we want is for the market to come down and stay within this zone down here. And this zone can be pretty wide. So if you've constructed in a way where it's pretty wide, then guess what? You're going to make the most inside this zone. And if the market was to go up above this put debit spread, let's just say you're wrong on your direction, that's fine because you still have a profit. So the only place we will start to take a loss is if the market really goes all the way down. That means to go past this put credit spread at the bottom. So if you construct this properly, it's going to be a high win rate. But at the same time, that doesn't mean that you're not going to have losses. Don't forget, if you have a high win rate, let's just say you have something like an 85% win rate, that means to say 85% of the time you will win. It also means that 15% of the time you're going to lose. And from this structure down here, you're not going to lose as much, but you're definitely going to have loss. What's important is that over the long term, you're going to be net profitable. Now, some people have asked me, but Davis, can I do the opposite? Can I do the call condor? And the answer is yes. And in fact, this is the other part of the strategy. So in this case, maybe you're slightly more bullish, then you can construct the call condor. So it's very similar to the put condor, and it's just the opposite. So you have the call credit spread at the top, and you're going to use this to finance this call debit spread. So again, very similar to the put condor, and it's just the opposite. So if you were to take a look at the max profit zone down here, so in case if the market actually crashes, then you don't have to worry as well, because over here, you still can be in a profit because you have a net credit of 37 cents on the trade. So one of the very common questions I get whenever I talk about this strategy is, Davis, why use the condor instead of a simple credit spread? Why you want to make things so complicated? Well, it's because it's a different strategy. So let me just compare the credit spread and the condor so you can see side by side. And there are actually some advantages of the condor. So in order to compare them, I need to compare apples to apples. That is where I need to construct both of them with the same max risk. So as you can see over here on the left-hand side, I've constructed the put spread, and you can see the max loss is 494. And on the right-hand side, I've constructed the put condor. The max loss is about 489. So very close, about $5 difference. So now that we have the max risk the same and we both are using the same short strike, we can have some comparison down here. So the condor in this case actually have a few advantages over the put spread. So the very first advantage is that it has a higher win rate. You can see over here, if I was to construct the same short strike with the same risk, the win rate is slightly higher by about 2%. As you can see in this case down here. Now you might be saying, but Davis, 2% is so small. Yes, in one trade, it's going to be very small. But if you're going to put this over thousands of trades, which you will eventually have if you continue to trade, this 2% edge can actually be pretty big. Because if you think about it, that's what the casino business is about. Because the casino business, on their games, they have a very slight edge over the player. But this slight edge, if you were to play out over a large sample size, is going to be net profitable for them. So similarly over here, although it's 2%, it can be a big difference over the long term. Now next, it's also harder to hit the max loss. So remember, I already made the comparison earlier with the SPX and the mini SPX. This is similar as well, because if you take a look at the put spread down here, the long put is at 524 for us to construct a risk of about $490. But on the put condor, for us to construct the same risk, we can actually stretch our long put a little bit further away to 521. So this is about 3 points away. So it makes it slightly harder to hit the max loss with the put condor. And also it has a higher max profit. So this is the big key difference between the put spread and the put condor. So you can see over here, the put spread, you notice the max profit is only $106. But if you use the put condor and you have the embedded put debit spread, you notice that the max profit is so much higher than the put spread. So when you have a higher max profit, this also translates to a better risk to reward ratio. So this was what I was saying earlier. Even though if you lose, you don't lose that much compared to how much you can possibly make when you make the max profit on the trade. So you can see over here, the max loss and the max profit, the risk to reward is roughly almost 1:1. Whereas if you were to take a look at the put spread over here, you can see that, you're risking $500 about there to make only about $100. So it's not that good of a risk to reward compared to the put condor. And that is why generally the put condor can be a better trade compared to the put spread if you compare side to side. Now, of course, they are both different strategies. That doesn't mean that you totally don't put on the put spread. The put spread is if you are very bullish. If you think that the market is going to keep going all the way up, then you put on the put spread. But if you're uncertain or you're a little bit bearish, then you can actually put on the put condor because you do have quite a good protection in this embedded debit spread. Now, next, you might be asking, but Davis, what about the iron condor? If you compare it to the iron condor, are there still advantages as well? And the answer is yes. So while the iron condor actually has a wider max profit zone because it's stretched out much further past the current market price, the condor actually still have some advantages, and the advantages are actually pretty similar. As you can see over here, first thing, you notice that the pop is so much smaller for the iron condor if I was to construct using the same short put spread. And then on the call spread side, I'm going to use the same delta that I used for this short put. So if you construct it in that manner and you compare the risk, right, the same amount of risk, then what you notice is that the win rate pales in comparison to the put condor. At the same time, if you take a look at the risk to reward ratio, the risk to reward ratio also is still not as good as the put condor. Now you might be thinking, but Davis, this might not be a fair comparison because they are, the pop is different. So what if you compare the iron condor with the same pop? So that's what I did. So what I've done is that I've adjusted the iron condor now so that the pop is similar to the put condor. So as you can see, the iron condor is about 72%, put condor slightly above, but take a look at the risk to reward. You can see that the risk to reward again is still not as favorable. You can see the risk to reward for the iron condor is roughly 1:5, whereas the put condor again pretty much close to 1:1. Okay, so now that I've got the comparisons out of the way, let's head on over to the option chain, and I'm going to show you how to construct it because it's a very versatile construct whereby you can change it to get the desired kind of structure that you want. Okay, so here I am in my tastytrade trading platform. You can use any other platform if you want to as well, as long as there's this option chain. So I'm going to go to the 43 DTs because, as you know, I like somewhere around the 45 DTs and above because that's where our edge is. So if you're going to be asking me, Davis, can I do this on 0 DT? Can I do this on 1 DT and so on? Then the answer is it's up to you because I like to trade where the edge is. So that's 45 and above. If you don't want the edge, then by all means, you can go to any other DTE that's below 45 if you want to. Okay, so what I'm going to do down here is I'm going to construct the put condor just for the example over here. If you want to construct the call condor, it's just on the left hand side down here where you're going to use the call option. So how I'm going to construct the put condor is going to be similar for the call condor, it's just the opposite. So the first thing you want to do is construct your put credit spread. So where do you actually construct your put credit spread? So this really depends on the risk to reward you want and also the kind of win rate that you want. So if you want a high win rate, but you don't mind a lower risk to reward ratio, then you can go to the lower delta. So let's say, for example, you want 75% and above. So if you want 75% and above win rate, then you want to construct something around 25 delta because based on the delta, it already tells you what is the percentage chance of this being in the money at expiration. So 25 delta just means there's about maybe around a 25% chance, which means to say this option strike down here will have roughly a 75% win rate. So if you were to take a look at the pop, all right, let's just move my face somewhere around here, okay? You can see over here, the pop says about 81%. As you can see, it's even slightly higher than what the delta suggests. And if you want an even higher win rate, you can just adjust this as well. Let's say you want to go to 20, it becomes around 85%. But if you want an actual higher risk to reward ratio, you can actually go for a nearer delta. So let's say around 30 delta. So you have about 77% win rate, but you get a better risk to reward ratio. So this is how option strategies usually work. The higher the win rate, the worse the risk to reward. But the lower the win rate, the better the risk to reward. So this is where you need to kind of pick which one you feel more comfortable with. So let's just say I want to go with the 30 delta ones. Now, once you've already decided on the short put strike, next is to define the risk of the trade. So you have a small account. So given that you have a small account, maybe you don't want to risk that much. Let's just say the most you want to risk is $500. That's the maximum you want to risk. So if that's the maximum you want to risk on any single trade, then all you got to do is just stretch 5 points out. So 538 minus 5 points is going to be 533. So as you can see over here, your max loss is only $382. You cannot lose more than $382 on this trade. And as you see later on, this is actually going to get better. Our max loss is actually going to drop when you start to include the debit spread. So let's just start off with this first. So the next thing we want to do is to construct our put debit spread. So starting off, you can just go to at the money. So this way, at least if the market just drops a little bit, it can get into your profit zone. So let's just try and construct a 1-point wide put debit spread. And as you can see over here, right off, you can see that we have 78 cents in credit. So this structure down here has no risk to the upside, and you have a pop of roughly about 72% or so. And you can see over here, our max loss have kind of dropped a little bit. Previously, it was slightly more than 322. Now it has dropped. So you can see over here, the risk to reward ratio is 178 to 322. That means for every $322 you're risking, you get about $178. So this is actually not so bad. So it's roughly about 1:2. Now, what if you want to have a slightly better risk to reward ratio? Then all you got to do is just widen out this put debit spread. So let's just say I go for 2 points wide. If I go for 2 points wide right now, you can see this. Now I have a max profit of 238 and my max loss is 261. You notice that every time I stretch this put debit spread a little bit wider, my max loss actually drops. And that's because when the market goes down, you're actually going to be profiting on this put debit spread. So any profit you have here, it offsets the risk that you have on the put credit spread. So that is why your max loss actually drops whenever you increase the put debit spread. So if I was to push this one more time over here, you can see now all of a sudden I have a much better max profit compared to my risk. You can see my risk is about $200, but I'm going to make $303. Now the trade-off is that you get lesser credits upfront. You get lesser premium upfront. So let's say the market was to go above this whole put condor construct at expiration. Then that means is that you're just going to get whatever credit that you have sold for at the start. So this is where you want to have a nice balance. You want some credit upfront, but at the same time, you want some nice risk to reward ratio. So this is where you can actually adjust it so that you can have quite a bit of credit upfront, and then you still have pretty decent risk to reward ratio. So this is the strategy that you can trade on SPX, or rather mini SPX if you have a small account. And hopefully this video has been helpful for you. And if it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe to my channel for more videos like this. And I will see you in the next video.